Salesforce Agentforce, a calculated cannibalization. Benioff's upsell strategy faces a critical market reality. Salesforce's Agentforce initiative, aggressively marketed as an upsell opportunity primarily through the $125 per agent annual retreat and the reassignment of 500 Salesforce workers, is demonstrably cannibalizing existing Salesforce revenue streams, a trend substantiated by the performance of BPO business process outsourcing providers increasingly utilizing a canary approach to assess the program's viability. The inherent conflict arises from the fundamental premise of expanding the Salesforce ecosystem while simultaneously eroding the core value proposition of its established solutions, creating a critical strategic vulnerability.
This situation demands immediate reassessment of the Agentforce business model, particularly regarding its integration with core CRM functionality and the long-term impact on customer lifetime value. The current trajectory, as evidenced by the observed market dynamics, suggests a significant and sustained revenue drag, necessitating a revised strategic approach before substantial further investment is committed.
The erosion of value, a shifting market landscape. The BPO canary signals a systemic risk to Salesforce revenue. The escalating adoption of BPO providers leveraging a canary model, initially deploying Agentforce to test the waters and assess its impact on core Salesforce revenue, provides irrefutable evidence of a significant cannibalization effect. This strategy, employed by entities such as Tata Consultancy Services and Wipro, reveals a critical realization within the market. Agentforce's pricing structure and functionality, particularly when layered on top of existing Salesforce deployments, are demonstrably undercutting the value proposition of standard Salesforce licenses.
The prevalence of this approach suggests a widespread lack of confidence in Agentforce's long-term sustainability, driven by concerns regarding potential vendor lock-in and the inherent limitations of a supplemental solution designed to augment, rather than fundamentally improve, existing Salesforce capabilities. Furthermore, the sheer volume of BPO deployments utilizing Agentforce indicates a systemic risk to Salesforce's overall revenue projections, fueled by the perception that Agentforce is a tactical workaround rather than a strategic investment.
The data clearly demonstrates a shift in market behavior, reflecting a growing skepticism regarding Benioff's initial projections.
Dissecting the mechanics, pricing, workforce, and market response. The complex interplay of cost, labor, and strategic perception. The Agentforce model's financial architecture, specifically the $125 annual engagement learning retreat and the reallocation of 500 Salesforce employees, creates a paradoxical dynamic whereby the operational costs associated with its implementation directly contribute to the erosion of the very revenue it aims to generate. This is compounded by the strategic perception within the market. The retreat, designed to foster engagement, is viewed by many as a thinly veiled attempt to justify increased operational expenditure, while the workforce reassignment further exacerbates the issue by diverting resources from core Salesforce product development and support.
The BPO canary approach, driven by cost optimization imperatives, reveals a critical market response. Companies are strategically choosing to leverage Agentforce solely for specific, low-value tasks, thereby minimizing the impact on their existing Salesforce investments and avoiding the substantial operational overhead associated with the full Agentforce suite. This deliberate circumvention exposes a fundamental flaw in Salesforce's initial sales strategy, predicated on the assumption of widespread adoption and integration across the entire customer base.
The underlying mechanics are creating a self-defeating cycle driven by perceived value and strategic risk mitigation.
Strategic implications, a path forward and potential consequences. The urgent need for a revised revenue model and risk mitigation given the demonstrable cannibalization effect and the prevailing market sentiment. A proactive reassessment of Salesforce's Agentforce strategy is paramount to mitigate potential long-term financial repercussions. The continued reliance on the $125 retreat and the workforce reassignment represents a significant misallocation of resources, particularly in the context of a fiercely competitive CRM market.
Failure to address this issue will likely result in a further decline in Salesforce's market share, eroding customer trust and ultimately impacting the company's valuation. Immediate steps must include a comprehensive analysis of Agentforce's true value proposition, focusing on demonstrable ROI for customers, and a revised pricing model that aligns with market realities.
Furthermore, Salesforce needs to actively engage with BPO providers to understand their strategic rationale and explore opportunities for mutually beneficial collaborations, moving beyond the current perception of Agentforce as a purely upsell initiative. A failure to adapt will not only impact Salesforce's bottom line but also damage its reputation as a market leader, highlighting the critical importance of strategic foresight and market responsiveness.